All right, this is Ubaid on behalf of Electronics, and in this video, we'll be talking about open market operations. Okay, now when it comes to open market operations has to do with monetary policies. It has to do with execution of monetary policies. Okay, so this is execution of monetary policies. All right, so when it comes to execution of monetary policies, the way the open market operations work is that the central bank they buy and sell bonds, and we're talking about treasury bonds. The central bank buy and sell treasury bonds. Now, you may ask how the central bank comes up with the funds or money to buy and sell treasury bonds, and the answer is thin air. Okay, basically, they print their own money. Okay, they create money out of thin air to buy and sell treasury bonds. All right. Now, when they buy and sell treasury bonds, okay, it does impact the interest rates as well as other rates that we're going to talk about in the next video. Okay. However, when they buy and sell treasury bonds, okay, this is how it works. Okay. When they buy bonds, let's say they buy bonds. Okay. Let's suppose your bank has assets and liabilities. Okay. This is assets. This is your T account over here, and you have liabilities somewhere over here. And the liabilities will be made up of deposits, okay, that the clients make in the bank account. Okay, so this is deposits. And in terms of assets, you have your reserves. So this covers both your required and access reserve. So reserves, okay, stored in the bank vault, for example. Okay, also covers bonds. Okay, so you have bonds, loans. Okay, so we're talking about loans that the banks give out to borrowers. Okay, it could be your line of credit, your auto loan, okay, your personal loan, so on and so forth. Okay, this is one way that the bank makes money. Okay, and that's the reason why it gives out loans. All right, so when it comes to central bank, when they buy bonds, they pump money into the system. Okay, how do they do that? So let's say they buy bonds, and the bonds are 100 bonds over here. So let's say the central bank goes ahead and buys 20 bonds out of 100. Okay, which basically means that the reserves will go up by 20. Okay, so let's say reserves are 100 as well, they go up by 20. Okay, and your deposits over here, they will stay the same. Okay, assuming that your loans are 100 as well. Okay, and your deposits over here, let's say this is 300 all in all in terms of your assets. Okay, and your deposits would be assuming 280, and the net worth of the bank for that reason will be 20. Okay, and this could be in millions, thousands, billions, what have you. Okay, so net worth, this is 20. All right, so when the central bank goes ahead and buys bonds, okay, you subtract 20 from 100, you add 20 to your reserve, which means now you have 120 over here, 120, let's say 120 million in reserves and 80 million in terms of bonds. And your loans will be 100. Okay. So 120 plus 80, this is 200, 200 plus 100. Your total will stay the same at 300. Your net worth won't change. Okay. However, when the bank, the commercial bank, let's assume that this is ABC Commercial Bank, ABC Commercial Bank. When the ABC Commercial Bank goes ahead and loans out some of this cash, some of the reserves, or some of the money from the reserves, okay, what's going to end up happening is you will add the money that these commercial bank loans out to okay, borrowers, let's say businesses. So assuming this would be 20 million over here, this will become okay 120 for loans, 120 million, and you'll subtract 20 from here, which means this will become 100. Okay, your total will stay the same at 300. Your net worth will stay the same at 20. Okay, this is how the central bank or the Federal Reserve Bank buys bonds from commercial banks, and this is the impact of that purchase. Okay, when it comes to your assets and liabilities. Now, the central bank also goes ahead and sells bonds. Okay, now when it comes to selling of bonds, let's say you have your assets and your liabilities. Okay, and you have your reserves, both access and required reserves, your bonds and your loans. Okay, so bonds and loans. And under liabilities, you have deposits. Let's say you have $80 million in deposits, $100 million in reserves, $100 million in terms of bonds, and $100 million in terms of loans. All right. So all in all, this will be 300, and your net worth, assets take away liabilities, so net worth will be, okay, assuming this is 300 minus 80, okay, this will be 220. Okay, so when the Federal Reserve goes ahead and sells bonds to commercial banks, let's say this is $20 million worth of bonds, so you're going to add bonds over here. This will become 120. Okay, and your reserves will be cut by 20 million. Okay, your reserves will be 80 million over here. Okay, and your loans will stay the same, assuming that the commercial bank, let's say ABC Commercial Bank, has not given out any new loans. Okay, so they haven't given out any loans yet. So your loans figure will stay the same at 100. All right, so all in all, this will be 300. Okay, and this will stay at 220. All right, so this is how the central bank buys and sells bonds, and this will be the impact of that transaction when it comes to your commercial banks and their balance sheet. That would be it for this video. On behalf of B Electronics, this is Obey. Have yourself a great day.